Hello everyone and welcome back to my channel Investing for Success. So today's video is going to be kind of a continuation of the previous video that I made, which was on the topic of how saving your money won't make you rich. If you haven't seen that video, I'll link it in the upper right corner of this video so you can watch that one before you watch this one. So once a person has realized that just saving their money alone is not going to make them rich, then they start to look for other ways to invest their money. And usually they start out by thinking that they can just give their money to someone else to invest for them. This might lead to things like GICs or mutual funds, or possibly even hedge funds, depending on how much money you have to put into the market. So we're going to talk about that today. Let's get right into it. Okay, so often the first step for people once they realize that just saving their money alone isn't going to make them rich is usually going to their bank. Maybe they have a financial advisor or something like that where they can go and discuss their options for investing their money. So some of the options that will come up will probably be GICs or mutual funds. Those are the two major things that banks will promote. And it will depend, they'll ask you your risk tolerance. So they'll say like, are you comfortable with higher risk, potentially higher reward, or lower risk with lower reward? On the low end, you'll be looking at something like GICs, and they range anywhere from partial percent interest to 3% on average. But the problem with the GICs that I see is that if you remember from our previous video, we talked about inflation. And that usually happens right around 3% per year, and that's guaranteed. The inflation is going to happen no matter what. The rate of inflation will vary slightly, but it's on average about 3% per year. If you don't remember what inflation was, it's basically the fact that what you buy today will cost you more next year and the following year. For instance, like if you bought a Coke 40 years ago, it might have cost you 10 cents, but now it's obviously going to be a lot more than that, $1 to $2, depending on where you buy it. That's directly the result of inflation. So if you're looking at the rate of inflation being 3% per year, and you're only making 3% at most with your GIC, you're either maintaining your wealth or you're actually losing value every single year. So I'm not going to really discuss GICs too much, and that's kind of the reason why, because in my opinion, it's not really a wealth growing option. It's more of a wealth maintenance option. So let's next get into what they'll offer you if you're looking at a little bit more risk tolerance, and that would be mutual funds. So let's talk about those. Okay, so mutual funds are basically pools of stocks that fund managers purchase, usually banks or trust companies, and they'll create a category like something like oil and gas or technology or financial stocks, and then they'll make a mutual fund out of that, which you can purchase a portion of. What they'll usually do is they'll judge your risk tolerance, and they'll recommend something based on that. So if you have low risk tolerance, they'll give you a low risk mutual fund, something like S&P 500 companies, like big name companies that are unlikely to fluctuate much over time, and they usually pay a lower return because of that. And then on the higher end, they'll have something like maybe like technology companies, and they'll have large fluctuations in the market, but over time the return is usually quite a bit higher. The risk is also quite a bit higher, obviously. So what they'll do is after they've ascertained your risk tolerance, they'll recommend one of those for you. Some of the problems that I have with mutual funds are that often they'll have management fees, and these fees can be anywhere from a partial percent up to, I've seen them as high as 3%. So if you're taking into account in the previous video where we talked about inflation being at 3% per year, and if your management fee is also at 3% per year, then you'd have to make actually 6% per year just to break even. So anything above that, of course, you'd be making some growth, but if you make 6% or less, you're actually losing money over time. So before you actually go out and purchase a mutual fund of any sort, make sure you get the information about what the management fees are. The second thing that I want to talk about with mutual funds is the fact that There's a lot of mutual funds that don't have any sort of performance bonus in them, meaning that the fund managers don't actually get any more money if they make you more money. So in that situation, they're actually de-incentivized to take high risk themselves to gain you better returns. In that situation, they actually want just more clients that are paying them more management fees rather than getting you really good returns, because it doesn't incentivize them in any way to do that. If you think about it in this way, that if they make you a 10% return one year, and then the next year they make you only a 2% return, it's actually going to drive a lot of clients away from that fund, and those management fees are what make them a lot of money, so they don't want that to happen. In a lot of situations, then they're actually really geared towards just playing it really safe, in which case you don't actually make very good returns because they're just trying to keep you in the fund and keep you paying those management fees. So that's different than some of these hedge funds that we're going to talk about later, where they actually do have a performance bonus. So if you got to actually make sure that that is either in place or not in place, and what the fees are there, make sure you discuss all that with your financial advisor or whoever you're talking to about these mutual funds. So those two things, obviously, if you're talking about a low return over time and a high management fee, you're really going to struggle to make financial growth over time. So just keep that in mind when you're looking and shopping around for mutual funds. But let's now talk about the kind of higher end of investment. If you've got a lot of money to put into the market, you might be looking at something like a hedge fund. So let's talk about those. Okay, so hedge funds are actually very similar to mutual funds in that they're basically just a big pool of stock. You give them a certain amount of money and they'll invest in the stock market for you, and hopefully get you a return on your investment. They're not run by banks or trust companies. They're usually run by high-profile investors, people that have made a lot of money for themselves or for other people. And then obviously other people will want to invest with them based on that. Companies like Greenlight Financial, run by David Einhorn, is a good example of a hedge fund. In recent times, he's actually lost quite a bit of money, but prior to that, he had a record of making very good returns for his clients. So people see that, and then they want to invest in hedge funds. Hedge funds usually require quite a large amount of initial investment, sometimes over $1 million. Depending on the hedge fund, it can be different, of course. One of the industry standards for hedge funds is what's called 2 and 20, and what that means is they'll charge you a 2% fee on your investment no matter what happens. If the value of your investment goes up or goes down, they'll still charge you that 2%. But that 20% is on any gains that you make on your investment. So if you make like a $100,000 gain on your investment, they'll take 20% of that. So obviously that's a huge amount of money that they take. And the reason that this is actually attractive to some people is because some of them make such large returns for you that 20% really doesn't matter in the end, at least not to them, because they don't have to do anything to achieve that. So those are kind of the two big problems that I have with hedge funds, is that the fees are kind of astronomical and that it really requires a lot of money just to get into initially. So I just wanted to cover that really quickly, but for most of you that's probably not going to be something that you're interested in, but just so that you're aware of it. Okay, so we've discussed GICs, or guaranteed investment certificates, we've discussed mutual funds, and we've discussed hedge funds, and hopefully you've come to the same conclusion that I eventually came to, which is that why not do all of this yourself rather than pay these people these astronomical fees to do it for you. And you can actually end up getting better returns overall if you do it yourself. It's not uncommon to get 8, 10, even higher % return per year by doing all of this yourself if you just take the time to gain the knowledge on how to do it yourself, which is what the point of this channel is going to be, and hopefully I'll be able to pass on some of the information that I've learned over the years in the following videos. So continue to follow along. The next video we're going to talk about kind of the stock market and why you shouldn't fear it. A lot of people fear the stock market, they see market crashes and so on. And I'm going to talk about why you shouldn't be in fear of that. So hopefully we'll see you in the next video. Thanks.